Today, SpaceX went public, and the harder it runs in these next few weeks, the more shares are being lined up to be dumped right onto you. See, SpaceX didn't just go public, they engineered today's pop to function as a mechanism that works against you. I know that sounds cynical, even dramatic, so let me earn it. Somewhere in the high rises of Manhattan, a group of investment bankers is watching the ticker tape move. Every tick higher, they smile a little wider. It isn't because they own the stock, it's because of a specific clause in the lockup agreement they helped draft. The higher the price climbs, the sooner that clause triggers. The pop everyone is cheering for today isn't a celebration. It is a countdown. Before I go any further, let me clarify exactly what this video is and what it isn't, because I want to be entirely honest with you. This is not a video about SpaceX being a bad company. By almost any metric you choose, it is a staggering success. It launches more rockets than entire nations. Starlink alone serves over 10 million customers across 150 countries. The defense contract pipeline is massive. If you came here looking for someone to tell you the rockets won't fly, you're in the wrong place. This is about something entirely different and, in a financial sense, far more critical. It is about the fundamental difference between a great business and a deal structure designed to favor everyone except the person buying the shares today. Those two things are not the same. The gap between them is exactly where ordinary investors hemorrhage money on high-profile IPOs. What I am about to show you is not a theory. It is pulled directly from the public prospectus SpaceX filed with the SEC. Anyone can read it. Yet almost none of the mainstream coverage you have seen today has touched it. By the time we finish, you will have a calendar marked with specific dates. You will understand why those dates matter infinitely more than the opening price on your screen right now. But first, we need an anchor on price, because it dictates everything else. SpaceX is going public at a valuation of roughly $1.75 trillion against last year's revenue of about $18.7 billion. That is nearly $94 of valuation for every single dollar of sales. 94 to 1 for a company that is still burning cash. To give you some perspective on how stretched that is, one of the most respected independent research firms on Wall Street conducted a rigorous forensic valuation of SpaceX and concluded that the company is worth closer to $780 billion. That is more than half off the price it is hitting the market at today. So, when I tell you this deal is structured to favor everyone except the retail buyer, that isn't a feeling. That is a hard mathematical reality. The current valuation already assumes the future has arrived. Everything that follows is about who gets to cash out if it doesn't. Let's build this from the ground up, because your entire understanding of this trade depends on it. When a company goes public, only a tiny sliver of its total shares actually hits the exchange on day one. In SpaceX's case, that's about 5%. The other 95% is held by the people who got in on the ground floor, the founders, the early employees, and the venture capital firms. Those insiders are contractually locked up. The logic is simple. If every holder of those cheap early shares dumped them simultaneously on day one, the supply would crush the price to zero instantly. So, most big IPOs use a standard 180-day lockup period to prevent that collapse. But here is where SpaceX did something remarkably unusual. Instead of a single cliff at 180 days, the way Rivian, Uber, or Palantir did SpaceX built a staggered release schedule. They've laid out 5 separate trenches that unlock at fixed intervals, plus 2 additional cliffs tied directly to earnings reports, and 1 aggressive performance trigger tied to the share price itself. That performance trigger is the part the headlines are completely ignoring. Here is what the prospectus actually says. If the stock trades 30% above its IPO price for 5 out of any 10 consecutive trading days before the first quarterly earnings report, an additional 10% of insider shares are unlocked for sale early. Read that again, 30% above the IPO price. 5 of 10 days. The IPO price is $135. 30% above that is $175.50. Any day the stock closes at or above $175.50 counts. Here is the kicker. The futures market, where the stock was being priced before today, was already hovering around $155. That is a 15% pop from the IPO price already baked in. This means the trigger isn't some far-off, unreachable mountain. The trigger is sitting roughly 13% above where the market already expected the stock to be. 1 good week is all it takes. That clause turns the day one pop, the thing people are cheering about on social media, into the starting gun for early insider selling. The harder the stock runs, the faster the supply is released. The pop isn't a victory lap. It is the trigger. Now, let's look at the calendar pinned to the wall. Today, June 12th, is day 0. About 5% of the company is in the float and 95% is locked away. Now look forward. Friday, August 21st, day 70, the first of 5 staggered trenches unlocks. 7% of insider shares become eligible to sell. Thursday, September 10th, day 90, second tranche, another 7%. Friday, September 25th, day 105, third tranche, 7%. Saturday, October 10th, day 120, fourth tranche, 7%. Sunday, October 25th, day 135, fifth tranche, 7%. That is 35% of all insider shares released in a slow drip between late August and late October. And those are just the time-based events. We haven't even accounted for the 2 massive earnings cliffs. The first lands 2 days after the Q2 earnings release. Depending on how they schedule it, that could be any time from mid-July to late September. Whenever it hits, an additional 20% of the company's shares unlock. The second cliff happens 2 days after the Q3 earnings report, usually between mid-October and late December. That's another 28%. Add it all up. 5 trenches at 7% is 35%. Plus 20% and 28%. That is 83% of insider shares released before the calendar even hits day 180. By mid-December, 6 months from today, the vast majority of the company is free to trade. That is the timeline you should be obsessing over, not the volatile frenzy of the first hour of trading. Why would SpaceX design a lockup this way? Why not the standard 180-day cliff? The answer is that this structure accomplishes 3 very deliberate goals. First, it avoids the cliff drop. When Rivian's lockup expired, the stock tanked 20% in a single session. When Palantir's expired, it fell 13%. Cliffs are brutal, visible, and make headlines. A staggered schedule, however, diffuses that selling pressure across a dozen smaller dates that nobody outside of legal experts is going to track. Second, it accelerates float growth. The faster that 5% float climbs, the quicker SpaceX qualifies for inclusion in major indices like the NASDAQ 100. New rules allow companies to be added in as little as 15 trading days, and they use a multiplier for small floats. SpaceX's 5% gets weighted as if it were 15%, forcing passive funds to buy massive amounts of the stock. Every tranche that unlocks isn't just releasing supply for insiders to dump, it is clearing the path for institutional money to flood in. That's not an accident, that's a feature. Third, it provides insiders with predictable exit windows. Day 70, 90, 105, 120, 135, plus the earnings cliffs. None of this is a secret, but it is buried in 150 pages of legalese. The asymmetry here isn't about secret information, it's about who actually reads the fine print. None of this is illegal. It is simply engineered. And it wasn't engineered for you. Consider the record. Palantir went public in 2020. Retail pushed it to $40, then the lockup hit, and it spent months recovering. Rivian went public, retail chased the 22% pop, and 6 months later, it fell 67% from its peak. Uber went public at $45, and on the day insiders were free to sell, it hit an all-time low. The pattern is consistent. The higher the speculative premium at the IPO, the more painful the expiration. SpaceX is trading at 94 times revenue. The room for things to go sideways is wider here than it has been in years. I know what you're thinking, but what about Elon? June 13th, 2027, day 366. That is when Musk's lockup ends. He is locked out of every single one of those early exits. The headlines will call that a positive signal of confidence. And sure, it is. The founder isn't dumping on you today. But every other insider, the early employees, the venture partners, the executives, is on that schedule we just mapped out. By the time Musk's lockup even begins to lift, the rest of the company will have had a full year of windows to cash out into retail demand. The person at the top stays safe. The people in the middle have multiple exit doors. The person buying today on their phone is the liquidity for all of them. So, where does that leave you? If you're genuinely interested in the business, don't fall for the two loud options. Option one is chasing the hype and buying at the pop the weakest seat in the house. Option two is writing it off entirely on principle. The third path is the quiet one. It costs you nothing but patience. Let the calendar do the work that the hype is trying to rush you past. 6 months from now, every restriction on that staggered schedule will have lifted. You will have actual verified Q2 and Q3 earnings reports. You will have real numbers to hold them to. The NASDAQ forced buying will have stabilized. All of those events are pieces of real data replacing pure speculation. The best companies of the last few decades stayed viable for years after their IPOs. You did not have to own them on day one to build generational wealth. The market rewards the patient far more reliably than it rewards the early. The thing being sold to you today as a once-in-a-lifetime act-now moment is almost always a stock that will still be there next quarter, at a price set by reality rather than by a countdown clock. The most important takeaway isn't the calendar itself. It is the habit of analyzing deal mechanics before you look at the headlines. Trigger clauses, unlock schedules, float math, index inclusion rules, they are all sitting in the public documents months before the price action starts. The advantage isn't inside access. The advantage is simply reading. That is the kind of thinking we cultivate for our members, the wealth logicians. Inside the vault, we have a library of these breakdowns that take this same lens and apply it to whatever is next on the calendar. If that's the kind of strategic thinking you want in your corner, the doors are open. But regardless, take the habit with you. The number on the screen today is loud. The calendar is quiet. The number on the screen fades in a day. The calendar runs for a year. Pick which one you let make your decision.